This is an Uncovered Japan Company research report on Takasago International, ticker 4914. Takasago is Japan's largest flavor and fragrance company and the only Japanese company in the global top 10. Today we will look at the defensible parts of the business, the volatility behind its low valuation, and what would need to change for returns to improve. The market snapshot in the research is straightforward. Takasago traded at 11.6 times forward earnings and just 0.71 times book value, while offering a 4.65% dividend yield. 72% of sales come from outside Japan. The central question is not whether the shares look optically cheap. It is whether the business can earn a return that deserves a higher multiple. Takasago sells the molecules that make familiar consumer products taste, smell, or feel distinctive. A flavor or fragrance is a small part of a customer's bill of materials, but a change can alter a finished product and trigger reformulation, testing, and regulatory work. That creates meaningful switching costs. The company combines flavors and fragrances with aroma ingredients and fine chemicals, making it broader than a simple ingredient supplier. The report identifies three distinct advantages. First, Takasago has a real menthol-chemistry niche and industrial know-how. Second, it has a century of customer relationships in businesses where switching is costly. Third, it has a differentiated footprint in Asia and emerging markets. The qualification matters. The global leaders have deeper research and development scale and stronger pricing power. So the moat protects the existing business more readily than it guarantees premium margins. Revenue has compounded at roughly 8.5% a year over the 5 years shown. But the operating profit line tells the more important story. Profit fell to 2.3 billion yen in fiscal 2024, rebounded to 15.3 billion in fiscal 2025, and then softened again to 8.1 billion in fiscal 2026. Raw material costs and foreign exchange make this a volatile earning stream, which is why a single-year price-to-earnings ratio needs careful interpretation. Takasago has a solid balance sheet, with a 56.6% equity ratio in fiscal 2026. That strength supports the dividend and gives the company room to invest, but return on equity was 6.2%, below the report's estimated cost of equity. This is the economic reason the shares trade below book value. The market is pricing a business that has not consistently earned enough on its capital. Cash flow adds another layer. Fiscal 2025 operating cash flow was strong, but fiscal 2026 free cash flow moved to negative 11.9 billion yen as capital expenditure rose. Investment in overseas capacity and growth can be valuable, but only if it translates into higher margins and returns. Investors should watch the conversion of this spending into operating cash flow, rather than relying on management guidance alone. Against flavor and fragrance peers, Takasago sits at the low multiple, low margin end of the group. The Western majors command higher valuations, alongside much stronger margins. The report's conclusion is deliberately cautious. The discount is not simply an overlooked bargain. It reflects a lower return operating model. A re-rating requires evidence that the margin gap can narrow. The strategic case narrows to two major levers. Takasago needs its emerging market fragrance investment to scale into better margins, and it needs to repair, shrink, or exit the low-margin aroma ingredients business. Fine chemicals offer additional optionality, but investors should focus on whether capital expenditure becomes cash generation, and whether return on equity moves closer to its cost of capital. The report argues that price to earnings can be misleading here because earnings are cyclical and volatile. Price to book is the clearer anchor. At 0.71 times book, the shares are near the bottom of the 5-year range. But that level is broadly consistent with a company earning a return on equity below its cost of capital. The valuation becomes more compelling only if returns actually improve. The research presents author scenarios rather than a single price target. By fiscal 2029, the illustrated bear, base, and bull outcomes range from 290 yen to 2,160 yen per share, before dividends. The range is wide because small changes in margins, foreign exchange, and execution have large effects on earnings. These scenarios are not recommendations. They are a framework for understanding the possible risk and reward. Takasago is a real global flavor and fragrance business with a defensible customer base, a menthol niche, and a dividend that pays investors to wait. It is also a lower margin, volatile earnings company, and the below book valuation reflects that fact. The evidence to watch is simple: margin repair, cash conversion, and a sustained improvement in return on equity. This is analysis for education, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.